Did you work on agenda around the board meeting?
Awesome. Every Tuesday, first and Thursday.
I'm so glad we could relate. Do you want to like do something on Thursday evening just because you can?
If you can. Okay, plan our yoga schedule around that. Twice a week we go on Tuesdays.
Well, we just got to
We go on Mondays and Wednesdays.
we just approved the building. So we, got permission from
Have you won any ball games yet?
So we're not supposed to keep score.
Yeah, so.
You got the internal score going, I know.
We haven't had any official games yet, but they did play like a mini game on opening night.
Oh, please. Do you have a whistle?
But it's pretty good.
I do.
For all
It's
intents and purposes.
fix it up.
She blows the whistle, but she doesn't know the
Mostly I
rules of the game.
just
I yell.
Fairly fun.
Works. Seems to work. I don't know.
It's,
Everyone wants to.
yes, you did that. It's a last.
That popped up on my thing too. Who's Marcus Lewis? He is?
Really? And of course, we're gonna sell our third.
Personnel supposed to show up. I talked about last year was like, why don't we take that function away? That only like BCs and above have that, because it's ridiculous. Somebody had a baby. Great. I know.
But they don't realize they're all personnel.
Like all 700 something personnel, I know. It used to be included in all personnel.
We will call to order the Finance and Audit Committee for the Sacramento Metropolitan Fire District, our meeting for August 24th. First order of business, call to order. You don't need roll call, you can kind of tell, right?
If you want to take public, well, we don't have any public comment, I'll tell you that right now.
Right.
And if you want to take consent with a motion and a second?
We'll do item, let's vote on the consent agenda then.
I make a motion to approve.
I second.
Excellent, we've got a motion and a second on the consent agenda. Any questions on the motion? Seeing no questions, such will be the order. You'd like a vote? All those in favor say aye.
That works.
Those opposed? The ayes have it.
Thank you.
All right, presentation items. Ms. Thomas.
Good evening, directors, Chief Harms. I'm going to start off this evening with a presentation and this is the financial report that covers the 12 months or the fiscal year ended June 30th, 2017. So this is the report that we do every 2 months, and this one happens to capture the entire fiscal year 16-17. I did want to make sure that I clarify at the beginning that the numbers that I'll be presenting tonight are preliminary results for the fiscal year. They're unaudited, so they are not reflecting any accruals or other adjustments that are made subsequent to the fiscal year, and that will be reflected in our audited financial statements. Those audited numbers will be presented to the full board probably in December or January. So the first chart that we look at is the district's cash balance. This reflects all of the funds that are held by the district, so it doesn't include the pension fund that's held by CalPERS or the OPEB trust fund, the CERBT fund that's also held by CalPERS. These are only district-held funds, but it is all funds, so it's not just the general fund, but it reflects all of the funds of the district and what the cash balance was as of June 30, 2017. So you can see, looking at that red line, that we ended with a total cash balance of about $61.7 million. And that was an increase relative to the 12 months ended June 30, 2016. There are a few reasons for that increase in cash balance. One is that we did some financing of equipment purchases in 16-17, and we had some unspent financing proceeds, so that increased the amount of cash we had at the end of the year. We also make contributions every year to the Pension Bond Stabilization Fund, so that balance is increasing, and that's included in this total cash balance. We have development impact fees that are accruing every year, and that fund is also included, so that contributes to an increase in our ending cash position. And then, as you'll see as we move through this report, we also had a contribution to general fund reserves as a result of higher general fund revenues than expenses, so that's adding to our general fund balance and to our overall cash balance. This chart is showing us those general fund reserves. So here we are looking at only the general fund, and we're actually looking at the unrestricted reserve amount in that general fund. The blue line is showing us fiscal year 16-17, and the red line is fiscal year 15-16. You can see that we ended fiscal year 16-17 with approximately $24.8 million in reserves, and that was higher than where we anticipated we would end based on budget. So that yellow dashed line is showing us where we thought we would end based on budget, which is approximately $21.4 million. So we're ending with a reserve ratio, which is our reserves divided by our expenditures, of 13.6%, and that compares to a budgeted number of 11.7%. So we ended the year better than budgeted. This chart shows medic cost recovery revenues, and if you remember when I was talking to you, when I was doing the February report or earlier in the year, we were seeing that those revenues were really trending below budget, and you can see that the red line is showing us the 16-17 revenue amount, the blue line is showing us budget, and green line is showing the 15-16 revenues, and you can see that in the early part of the year we really were trending below that line. We did see an improvement in the end of the year, and we actually ended with a cash receipt number. So this is a number that will adjust based on audit, but the total amount that we collected during the year was $33.34 million, and we had budgeted for $33.37 million, so very close, within about $30,000 of the budgeted number. Looking at our total revenues, again, the actuals ended up really close to budget, and in fact a little bit better than budget. So we had actual revenues of $189.4 million compared to a budget of about $188.2 million. The reason for the increase is primarily related to our property tax revenues being higher than budgeted. Turning to look at expenses, this chart is showing the salaries and benefits expenses. So total actual salaries and benefits expenses for the year of just over $157 million compared to a budget of about $157.5 million. So very close to budget there, about $500,000 under budget. And looking at total expenditures, you can see close there as well. Overall total budget of $188.9 million and actual spending of about $186.8 million. So $500,000 of that difference is related to salaries and benefits expenditures, and the rest of it is related to cost savings in services and supplies, so amounts that were budgeted but not spent in 16-17. And finally, this chart is showing us the balance in that SERPed fund. So again, this fund is not held by the district. It's a trust that's used for retiree health, so for pre-funding those retiree health benefits. The total balance as of the end of the fiscal year was $27.3 million. You can see that over the life of our participation in the fund, that's made up of about $23.8 million in contributions and almost $3.5 million in investment earnings. So just to summarize the fiscal year ending June 30, 2017, our unaudited numbers are showing an excess of revenues over expenditures of approximately $2.6 million. So that's the amount that gets contributed to the general fund reserves. And that actually compares to a budgeted deficit of about $700,000. So we had budgeted that we would have $700,000 more in expenses than revenues, and in fact, we had $2.6 million more in revenues than expenses. Some of the reasons for that were that our property tax revenues were higher than budgeted. The medic cost recovery, again, as we talked about, was right on target, and then we did have cost savings in our services and supplies expenses. So our unaudited general fund reserves at the end of the fiscal year totaled $24.8 million. That represents about 13.6% of net budgeted expenditures. And that number compares to the 15% that the board has set as a target for reserves. It also compares to a budgeted amount of $21.4 million, or about 11.7%. So again, ending with a higher reserve balance and reserve ratio than we had budgeted for. And then finally, our SERPed fund has seen strong investment earnings. So as I mentioned, about $3.5 million since inception. And actually, I think close to $2.5 million of that occurred during the fiscal year 16-17. So it was a strong investment earning year for the fund. And that concludes my presentation, but I would be happy to take any questions.
I would say that it is good news.
Yes.
It is good news. Yes.
I would say that it is good news. It's nice to see, and hopefully this is a trend that continues over the next few years. Thank you very much.
That's a good segue to the next presentation.
All right, then. So now we have our final budget, fiscal year 2017-18.
Yes. So I will this kind of moves us right into talking about the current year that we are in, which is fiscal year 2017-18. The final budget is being presented to the committee this evening in anticipation of recommendation to the full board of directors at the next board meeting on September 14th. So just to kind of give a little bit of background, the current year that we are in, fiscal year 17-18, we're currently operating under the preliminary budget, which was adopted by the board on June 8th. And in that preliminary budget, we were showing a $1.3 million general fund deficit. So that's $1.3 million more of spending than revenues, or a $1.3 million use of general fund reserves. Since the adoption of the preliminary budget, we now have better information about our expected revenues and planned expenditures for the year, and that's what's resulting in these recommended final budget changes. So the final budget changes relative to the preliminary budget are an increase in general fund revenues of $1.9 million. That's primarily resulting from revised property tax estimates. So you saw when I was talking about 16-17 that we ended up with higher revenues than expected. We're seeing that flow over into 17-18. So kind of starting from a larger or a higher base and projecting additional growth for the year in 17-18. We're also showing an increase in general fund expenditures of $1.5 million. That's primarily in services and supplies, and it's restoring some things that were requested but not able to be accommodated in the preliminary budget relating to facility maintenance and training expenses. And then we have $3.3 million increase in our estimated beginning reserve balance. So that's resulting from 16-17 ending with a positive 2.6 million as opposed to a negative 0.7 million. And that's resulting in an increase in our beginning reserve balance in the general fund. So we're projecting now with the recommended final budget that the reserve ratio at the end of the year would be 12.1%, and that compares to an original projection of 10.4% based on the preliminary budget. So this table is showing us the recommended final budget for all of the district's funds. We will focus tonight in our discussion on these first four funds. I'll talk most in detail about the general fund. We'll also talk about the capital facilities fund, the leased properties fund, and the grants fund. I do want to show the budget for the development impact fees fund here. So we are projecting revenue of about $1.5 million, a small amount of expenses. So overall, about a $1.4 million addition to this fund. And you can see, looking at the bottom line, we're projecting that we will end the year with $4.3 million in the development impact fees fund. Again, that revenue can only be used to mitigate the impact of new development by building new fire stations and equipping new fire stations. So that's really being set aside for future development. And then finally, the last fund that we show here is the IGT fund. And we talked about this at preliminary budget, and not much has changed. But just to remind you, we are expecting 2 years worth of IGT activity to occur in this fiscal year. So what we're showing is that 1 year's worth would be transferred to the general fund in 17-18. So that's approximately $6 million that would be going to fund general fund expenses in 17-18. And the remaining amount would be transferred to the general fund in 18-19 because we would normally expect to see that revenue in 18-19. Just to kind of show you a little bit what that looks like. So if you look at the general fund column, you can see we have general fund revenue of almost $191 million. And then we're adding to that second number that's circled there, that $6 million that's coming in from the IGT fund. So it's really the combination of those two that's available to fund expenses in the general fund and transfers out of the general fund. So when we compare those combined revenues to the combined uses of general fund resources, we're ending with about $945,000 more expenses and transfers out than we have revenues and transfers in. So that's a $945,000 use of general fund reserves. You can see that we're estimating that we're starting with about $24.8 million in the reserve at the beginning of the year. And so we would be ending with roughly $23.8 million at the end of the fiscal year. Looking a little bit more closely at the general fund and kind of what some of the year-to-year changes are in that fund. This table is shows a column for last year's budget, last year's unaudited actual results, the preliminary budget for this year, and now what we're recommending for the final budget for this year. And then that variance column, the very last one, is comparing the final budget to the unaudited results for last fiscal year. So if we look at the first line, revenues, you can see in that kind of pink shaded column that in 16-17 we had revenues of about $183.4 million, and then we're projecting for 17-18 that we would have revenues of $190.7 million, so $7.3 million year-to-year increase in general fund revenues. If we look down to the total expenditures line, in 16-17, there were total expenditures of $181.8 million, and we are recommending a final budget for the general fund, which includes total expenditures of $193.1 million, so an $11.3 million increase in total expenditures. And then looking down to the second to last line, that total transfers, that's giving us the net amount when we take into consideration the amount that's being transferred in, primarily from the IGT fund, and then subtract the amounts that are being transferred out, primarily to the Capital Facilities Fund, but also to the Grants Fund and the Leased Properties Fund, we can see that in 16-17, the total net transfers were just over $1 million. And in 17-18, we're showing about $1.5 million. So about a $500,000 improvement there year to year. And then just looking down at that bottom line number, you can see that 16-17, this is the same number that we talked about in the report that I just gave. There was $2.6 million more in revenues than expenditures. So that was a $2.6 million addition to reserves. And now we're showing for 17-18 recommended final budget that we would have about a $900,000 use of reserves. And you can see that that is a bit of an improvement from where we were at preliminary budget, which is the column one over to the left, where we were showing about a $1.3 million use of reserves. So looking at general fund revenues, this is a chart that you've seen before. It's changed slightly since you last saw it because we do have a bit of an improved picture for property taxes primarily. So this is reflecting the final budget number as well as the unaudited results for 16-17. The general story really hasn't changed, but I think this kind of helps put things in context a little bit. If you look at the property tax line, you can see that it really wasn't until 16-17, so just last fiscal year, that our property taxes recovered to the pre-recession level. So it took essentially the length of this chart for that to happen. If you look at the total revenues line, you can see that recovery happened a little bit sooner for us. So in terms of total revenues, in 13-14, we were back to where we were before the recession. And really the reason for that is the medic cost recovery revenues and the GEMT program and the IGT program, and really being able to enhance those non-property tax revenue sources. So in 17-18, property taxes are representing roughly 70% of total revenues, whereas in 07-08, they were about 80% of total revenues. And this chart shows us that breakdown a little bit more specifically for 17-18. These numbers reflect only general fund revenues, so we're excluding IGT from these numbers. But if we look at the general fund revenues, property taxes account for about 73%. Still obviously, by far the most significant revenue source. But our medic cost recovery is just under 20% of total revenues. And then, you can see the other categories break down that we have 3.4% for other charges for services, 2.2% other governmental agencies, 1.4% for inspections, permits, plan review, and then a small amount for miscellaneous other revenues. So looking at total general fund revenues for 17-18, we're projecting $191 million. As I mentioned, that's overall a $7.3 million increase compared to the unaudited results for 16-17. That's really attributable to primarily property taxes going up, we estimate about $7.8 million year to year. We also are showing an increase in our medic cost recovery revenue, about $3.2 million. That's a combination of two factors. One, that we have additional contracted units in the system that we were billing for for the entire 12 months of the year versus only 7 months in 16-17. So that's going to result in additional revenue. And then secondly, that we have a planned rate increase, which would help us to ensure cost recovery for our ambulance service. And the combination of those two is resulting in about an additional $3.2 million in collections. And then finally, offsetting those two, we're showing at this point what is a $3.8 million decrease related to deployment reimbursements, and that's really just a function of timing. So you'll probably remember that we typically don't include either the revenue or the expense associated with deployments until our mid-year budget, when we have a better idea of what that activity has been. So from a net budget standpoint, there is no impact by not including it, but when we are looking backwards and comparing to a year where it was included, there's an adjustment that needs to be made as a result of that. So when we do adjust that out, the net increase in the general fund revenue is $11.1 million year to year. And then in addition to that $191 million in general fund revenue, as I mentioned earlier, we have $6 million that's coming in as a result of IGT. And that's about a $100,000 increase compared to the IGT amount for 16-17. So turning to look at general fund expenses, this is pretty consistent with what we've seen in past years. Labor expenses represent about 85% of the general fund budget, 13.3% services and supplies, and then much smaller amount, 1.6% for taxes, licenses, assessments, and contributions. The recommended final 17-18 labor budget is $164 million. That's a $7.3 million increase compared to 16-17. Again, when we adjust for those deployments, so the fact that those expenses aren't included in 17-18 but are in 16-17, the net increase is $10.3 million or 6.7%. Those increases result from the scheduled salary increases that we have year to year. Also increased payments related to unfunded pension liability, which we've talked about in past presentations. There is sort of another timing issue related to holiday pay and when employees have chosen to cash out that pay on a calendar versus fiscal year basis that's having more of those expenses show up in 17-18 versus 16-17. So there's a bit of an increase as a result of that. And then we're assuming additional filled positions. So we're budgeting that all of the authorized and funded positions would be filled. And then we're also reflecting the costs of positions that were approved in preliminary budget. So we had a facilities technician and 2 inspectors for half the year, and then also some temporary positions for training overlap as people leave. So those costs are included in the budget. Offsetting the additional filled position costs, we have we're showing reduced overtime. So if we have more filled positions in 17-18 than we did in 16-17, that's going to result in less of a need for overtime. And there's about I think it's about a 27% reduction in our callback overtime as a result of that assumption. I do want to point out that that doesn't always materialize. So we intend to fill positions. We're not always able to recruit and fill all of the positions. But what ends up happening and what we've seen the last few years is that those things balance each other out. So if we've budgeted for salaries and benefits for positions that aren't filled, we have a savings there that then is offset by the increased overtime cost as a result of staffing those positions on a daily basis. So turning to look at services and supplies, our final budget for services and supplies is $25.7 million. That's about a $3.9 million increase compared to 16-17. The largest factor there is a little under $1 million, again, resulting from that 12 versus 7 months of contract ambulance service in 17-18 versus 16-17. And then there are various other increases for training, building services, fuel, safety clothing and supplies, and then also the procurement and implementation of a replacement enterprise resource planning system. So those are the things that are contributing to increases in services and supplies, and then those are offset somewhat by reductions as a result of one-time expenditures that we saw in 16-17 for communications equipment and election services that we don't have in 17-18. The final category of general fund expenditures is debt service, assessments, and contributions.
Pardon me.
Bless you.
Thank you.
That totals $3.1 million. The largest component of that is $1.8 million that's paid to the county for administration and collection of property taxes. And then the bulk of the rest of it results from debt service payments. We have about $900,000 in general fund debt service payments that you can see listed out here. And then finally, after revenues and expenses, we have the transfers in and out of the general fund. So the net there is a total transfer coming into the general fund of $1.5 million. and that's made up of $3.9 million that's going out to the Capital Facilities Fund. And I'll talk to you a little bit about how that comes about when we get to that fund. But that is a $1 million decrease, so $1 million less of general fund resources being used compared to last fiscal year. We have about $600,000 that's going out to the Leased Properties Fund, and again, I'll talk to you about why that is. And then we have $6 million that's coming in from the IGT fund, which we've already talked about. So this table is showing us the budget for the Capital Facilities Fund. I think I'll probably focus on that final column, which is the blue column, and this sort of explains what we're doing in that fund, what funding is already there, and what needs to come from the general fund. So if you look at the total revenue line, you can see that we're showing about $4.9 million in revenue in the Capital Facilities Fund. Most of that is coming from financing proceeds. So we're assuming that $4.1 million of the vehicles and equipment that we buy, we will finance through lease financing. So that's really offsetting the cost that we'll show down below. And then it is resulting in additional debt service payments because we finance those over a 5-year period. Looking at total expenditures, you can see the final budget is for about $10.8 million in total expenditures, with about $6.5 million of that being actual capital purchases, so buying equipment, vehicles, and about $4.2 million of that being debt service. So that's paying for equipment, it's sort of paying the loan on the equipment that we've purchased in prior years, as well as about $400,000 of that I think relates to equipment that will be purchased in 17-18. So overall, when we compare the revenues to expenditures, we have $5.8 million more in expenditures than revenue. We actually have a balance in the Capital Facilities Fund of about $1.9 million, which is the same as the negative number that you see down at the bottom. So we're able to use that, and that exists because there was money that was transferred into the fund for purchases last year, and those purchases weren't made. So they were rebudgeted to 17-18, but we have the funding in that fund to make those purchases, and that's reducing the amount that needs to be transferred from the general fund this year. So that net amount that comes from the general fund is the $3.9 million, which is basically the difference between the 5.8 and the 1.9. So just kind of go over some of that again. That net funding requirement from the general fund is $3.9 million. That results from $6.5 million of capital outlay, which is offset by $4.1 million in financing proceeds, and then that $1.9 million that's already sitting in the Capital Facilities Fund. In addition to those capital purchases, there's $4.2 million in debt service payments that would need to be made. Again, about $400,000 of that is related to 17-18 capital purchases. And of that $6.5 million in capital purchases, you can see the largest items listed here. So we have completion of the station alerting project that was started last year. That's going to be about $1.2 million of cost this year. We're purchasing a hazmat truck that's about $1 million, 3 ambulances, $600,000, 3 Type 6 engines, $600,000, and then an air rig for $600,000. There are other items. These are kind of the largest dollar amounts of the planned purchases. So next, turning to look at the grant fund, and again, I'll just focus on that blue column, which is the final budget for 17-18. You can see we have about $1.5 million in total revenue, so that's all grant revenue, and that is representing 3 grants that we have. So there's $1.2 million of that $1.5 million is coming from our SAFER grant, which is currently funding 9 firefighter positions, and that will be expiring at the end of August 2018, so not during this current fiscal year, but early in the next fiscal year. The remaining $300,000 in grant revenue is split fairly evenly between the 2 other grants. So one is for the certification of the Zinfandel training site, and then the other is for the advanced bulk storage response training. That last grant, the training grant, does require a match, so that's where that $16,305 that you see coming in from the general fund is resulting from, so that's the required district match on that grant. So the last fund that we'll look at is the leased properties fund. One of the key assumptions for the budget for this fund for this year is the leasing of the first floor of this building, which we do expect to happen within the next few months. So as we've talked about at preliminary budget, as a result of that, there will be one-time upfront costs associated with making improvements to the space, and that's resulting in a deficit in the leased properties fund in 17-18 that's requiring a transfer in from the general fund. So if you look at total revenue, we're showing about $900,000 in revenue in the fund compared to total expenditures of about $2.4 million. Again, most of that being due to those one-time expenses, which is resulting in about a $1.5 million deficit in the leased properties fund. There is approximately $900,000 in that fund that will be used to fund most of the deficit, and then the remaining amount, just under $600,000, would be coming from the general fund. So that $600,000 for that one-time expense is really accounting for most of the overall deficit that we're showing in the general fund, which is about $900,000. So that kind of wraps up my discussion, of the specific funds. In summary, our projected general fund reserves at the end of the fiscal year are $23.8 million. Again, that's roughly 12.1% of net budgeted expenditures. But looking beyond 17-18, and as we've talked about, there are some challenges in terms of aligning our future cost and revenue growth. So some of the challenges that we've talked about and have been identified relate to our pension costs. So we know that there will be increasing payments related to unfunded liability, and that's really been compounded by the discount rate reduction that's going to be phased in by CalPERS. We also know that there are significant capital replacement and maintenance needs. So we have SCBA replacements that will be happening, and also vehicle replacements that are going to result in additional capital costs being incurred over that 5-year period. I mentioned earlier in the presentation the expiration of the SAFER grant that will occur in fiscal year 18-19. So that's providing approximately $1.2 million in annual funding. As I said, it's funding 9 firefighter positions. So that will be a challenge in terms of absorbing that into the budget. And then finally, we've talked about the uncertain future of the IGT program. You can see that that's providing about $6 million in annual funding to the general fund. So any substantial reduction or elimination of that program would be difficult to absorb. So looking at where we've been and where we're going, you can see that 14-15, 15-16, and now our results for 16-17, we really have been able to keep our expenses equal to or less than our revenues. So our revenues have been sufficient to fund required expenditures out of the general fund. And then what we're showing for 17-18 is, again, essentially balanced. We do have some one-time costs in 17-18 that we're using reserves for, but essentially we're maintaining that alignment. It really is as we get into this next 5-year period where we see expenses, particularly in the first 4 years of that period, outpacing our revenues. So the expenses being that green line and the revenues being the red line. The picture has improved somewhat from the last time we talked about this, primarily because the property tax revenue picture has improved, but the same general imbalance still exists. So to the extent that our expenses are higher than revenues, that means that our reserves are being used to make up the difference. And this chart is really showing us what those revenue and expenditure numbers would result in terms of a reserve balance. And really over that 5-year period of time, we would be using approximately $20 million of reserves. So you can see that by the 2022 22-23 year, we would be under $5 million in reserves, or about 1.6% of our net budgeted expenditures. So, while we certainly are going to continue to explore funding opportunities that exist for staffing and equipment costs, I think, what these numbers continue to indicate is that, there likely will be tough choices to be made in future budget years. And I think we can, start seeing that in 2018-19. Don't see the picture changing dramatically over that 5-year period. Again, a slight improvement based on property tax revenues, but not really changing fundamentally the picture. And on that happy note, I'd be happy to take any questions you have.
Any questions from the group?
No.
No questions. All right, then.
I just have Amanda, can you go back a couple slides? One more right there.
Nope. That one?
Nope, one more. You were right on it.
Oh, I was on it.
There you go,
This
right
one.
there.
Okay.
And you mentioned it, Director Kelly, is that we had a really good year last year. Is that if you look at the last couple of them, our revenues has been equal to our expenses, and we've been able to come in just under budget. A portion of that, if you really look at it, we're at like about 1 or 2% of where we under budget. The thing about it is, and Greg and Brian are both sitting here, Greg has 85% of the budget. And he smiles all the time, and that's why Brian is looking grumpy there, because he's only got about 13%. But out of the 85%, it really is the labor side of it, in which we follow the contract and overtime and deployment, and we don't have a lot of flexibility. Brian is grumpy a lot of the times just because of what we're not doing is some of the things that Amanda talked about, which was those capital. And his group has done a great job of keeping us going. But one of the things I think as a group, as the exec staff, we feel we're not getting ahead because of that. We're just maintaining stations and keeping them going, but we're not able to go in and do major remodels, or we're not able to go in. And I'm not complaining. I mean, as long as we're in the positive side here, this is really good. The information of increased property taxes, increased revenue coming in from the ambulance billing side of it, all of it is really good. But I think our challenge is more as we look out and say, okay, we were able to replace the hazmat vehicle, and that's $1 million, but what we didn't replace was probably 3 or 4 engines. And we were able to replace 3 ambulances, but we probably needed to do more as far as those. And Amanda mentioned it, is that next year we'll lose the SAFER grant, and we'll work to try to be able to replace the SAFER grant. But right now where I'm at is that I don't want to reduce services. So we'll figure out a way to keep that truck in service and figure out how we'll get the money to be able to staff that as we go forward with it. And then just with the SCBA's timing out, that'll be a one-time hit, but that'll probably be about $7 million. We'll work for grant funding. We'll work at discussions and can we take 3.5 out of this budget year and 3.5 out of next budget year to try to figure out how we make those things work and move forward. So again, it's not a complaint. I'm very happy. The staff does a great job if we look at the day in, day out budgeting and prioritizing the spending of funds. But as a group, as the exec staff, it's really where do we want to be in the 5 years and how are we going to get there as we move forward.
All right, thank you, Chief. Any questions of the Chief? No? All right. Ms. Thomas, thank you again.
Thank you.
All right, then. Takes no action by this body. We will discuss our next meeting date of October 26th. It says we will not meet in September as the final budget will be adopted and our regular meeting will be off-site. Do we know where it's going to be off-site?
We're looking at a few options at some of our stations that can accommodate us.
Okay. All right, then. Any anticipated actions or presentation items for next meeting? Nothing from you? All right, then we will adjourn. Thank you.